Let's go through Chapter 10. Chapter 10 is about partnerships, formation, operation, and basis. So we've kind of moved on from corporations now. So a new topic. And as always, take a look at the big picture. And this is I kind of like this one. And this is a bakery. For 15 years, Maria has owned and operated a seaside bakery and cafe called the Beachsider. She'd like to expand and has talked to her landlord Kyle about it. The Beachsider is one of several older buildings on a 3-acre property. Basically 3 acres of a 10-acre parcel that Kyle inherited several years ago. The remaining 7 acres are not yet developed. Kyle and Maria talked to Josh, a real estate developer, and he proposed an expansion to the Beachsider and upgrade to the other buildings. So basically just kind of taking some of that land and expanding it. They agreed to form a partnership and own and operate the Beachsider and improve the lease on the other buildings. And improve and lease the other buildings. Under the plan, Kyle and Maria will each contribute half the capital needed. Kyle's real estate's valued at $2 million. Maria's bakery equipment and the cafe furnishings are valued at $500,000. The improvements will cost about $1.5 million, and Maria has agreed to contribute to the partnership that amount. Josh is not contributing capital. Instead, he's going to provide his expertise as a real estate developer. So he'll manage construction and operation of the partnership and receive 5% of the capital, a fixed salary, and 20% of the ongoing profits. His capital interest will be $200,000. What are the tax consequences if the trio forms beachside properties as a partnership to own and operate the shopping center? What issues might arise later? And then, of course, kind of go through the chapter to formulate what the responses are and then how that'll turn out. And again, this is a really long chapter also with a lot of slides, so I'm not going to necessarily cover everything. I'm going to go through what I think is most important in terms of doing the homework. So clearly we have to understand what a partnership is. 2 or more people that contribute money, property, labor, and expect to share in profit and losses. So you can contribute your knowledge, your labor, your expertise. It does not have to be money or property. For tax purposes, it includes a syndicate, group, pool, joint venture. A partner can be an individual, a corporation, and so on. So remember now we're talking about pass-through entities. So we spent about 3 chapters talking about C Corps, but now we're kind of going back to the pass-through entities we talked about way back in week 1 of the class. So a general partnership is 2 or more people, jointly and severally liable, if I can say that. Creditors can collect from both parties personal assets. So both are pretty much on the hook for deeds done by the partnership. General partners' assets are at risk from malpractice of other partners, even if personally not involved in malpractice. So it leads to an LLC, which is a pretty common type of business. And I should mention that these are on pages 2 and 3 of chapter 10. So I think we know quite a bit about LLCs. They were mentioned back in chapter 2. And then the owners are members, not partners. And then we have LLPs, limited liability partnerships, or I should say limited partnerships before I get ahead of myself here. A limited partnership has to have at least one general partner. It could have a whole bunch of limited partners. Only the general partners are liable to the creditors. The limited partners, their loss is totally limited by what they invested. So if they each put in $100,000, for example, they can never lose more than that. Whereas the general partner, personal assets may be at risk. Now I'm going to get to LLPs, which I got ahead of myself about. Limited liability partnerships used primarily for service entities. And this is what's unique about this one. An LLP partner is not personally liable for malpractice committed by other partners. So a large accounting firm would, for example, would be an LLP. A law firm, medical practitioners could be set up as an LLP. And that way, if one party does a malpractice, only that one partner is on the hook and nobody else is. So let's go back to the big picture. Kyle, Maria, and Josh need to figure out what kind of entity to be. They've narrowed it down to be a C Corp or a partnership. Assume all three owners are single individuals in the highest tax brackets, even before considering Beachside's income. So they're all single in the highest tax bracket. If they form a C Corp, the entity will pay them modest salaries and distribute all remaining cash flows as dividends. Wages paid would be subject to a 37% tax plus employment taxes. Basically, they're at their personal rates. The C Corp's taxable income would be 21%. We all know that. We just got done with that. The remaining 79% of income can be distributed and would be taxed at 23.8%. 20% tax on qualified dividends, and 3% net investment income tax. The combined effective tax rate would be about 39.8%. If they form a partnership, the income will be subject to 137% tax plus employment taxes, right? Because we're assuming they're all at the highest single rates. Okay. Also, in addition to the extent of the income is qualified business income, remember the QBI stuff we talked about earlier, they can deduct 20% of that, which effectively gets their tax rate down to 29.6. So in the example here, then, this is the business form that they should choose because the tax rate's 29.6 versus the 39.8. So obviously that's a big number, and they should choose a partnership business form instead. Now to decide what type of partnership to use, there's plenty of options for them. They can do the general partnership. They could do a limited partnership. They all want to have limited liability. They decide not to use a general limited partnership. They do not consider limited liability partnership because entity form is typically reserved for service providing companies. And remember that this is a bakery and property management. They're going to lease out properties to other businesses. So it's not a service type entity that we would associate with that. With a limited liability company, each partner of losses will be limited to partners' contributed capital, so they choose an LLC, which is generally the form that I would probably tell most businesses to go with. So the LLC just basically says the limit of their losses is what they contributed to the LLC and nothing above and beyond that. So Maria put in, her business, she's going to put in money to do the upgrades to her property. Kyle puts in the value of his property and so on. That's the limit of their losses. They can't lose more than that. So that would be the one that makes the most sense. The check the box regs, basically when you're filing with the IRS is basically kind of what you're thinking through is how do you want to be taxed. Allows most unincorporated entities to select their tax status. So you can just check the box with the IRS. You're filing a form, and then you choose to be treated as a partnership or a corporation. So which might be separate than what your legal form of the business is. Okay, key concepts in partnership taxation. This is on page 4. Also on page 4, there's a really good table there that shows just a nice high-level summary of the different partnership types. So if you have some questions on some of the homework that asks you questions about the different partnership types, that's just a one-stop shop to take a look at that. So remember, the partnership itself is not taxable. It's a flow-through, pass-through entity. Income is taxed at the owner level, not the entity level. Involves 2 legal concepts. Treats the partnership as a channel with income, expense, and gains flowing through to the partners. So it still files a return. There's a partnership tax return, and you guys will be doing one for a future assignment. And then it treats the partners and partnerships as separate and is reflected by the partnership files the information return. It doesn't pay tax, but it files a return. And then it treats partners as separate from the partnership in certain transactions between the partners and the business itself. So generally, the calculation of partnership income is 2 steps. Net ordinary income and expense related to the trade and business of the partnership. That's 1. And then step 2, segregate and report separately stated items. The reason we have separately stated items is that some items, when they go back to the owner's returns, might be taxed differently. It's because each partner has their own tax stuff going on individually. So separately stated items, like something like charitable contributions, might be treated separately because maybe one partner itemizes and one partner doesn't, for example. So each owner normally has a capital interest measured by the capital sharing ratio, a profit and loss interest. Basically, you get some percent of income, and then certain items may be specially allocated. Then you have basis, inside and outside basis. Basically, what is the basis of each asset that the partnership owns? So each partner owns a share of the partnership's inside basis of all the assets. The outside basis is basically each partner's basis in the partnership interest. All partners should maintain a record of the respective outside basis. And they talk about that on page 5, so just so you know. As I mentioned, the partnership files its own informational return, the Form 1065. You will have an assignment later on to do one of those with the software that you downloaded. No tax is calculated or paid with the return. It must be filed by the 15th day of the 3rd month, so basically March 15th. And then that gives the owners until April 15th to take that information and use that to file their personal returns. Then page 1 of the return reports ordinary income or loss from trade or the business activity. And then Schedule K accumulates information that goes back to the partners. And then each partner and the IRS receives a K1, basically saying, here is what your share of the business is, which your profit, losses, gains, and so on is. So that K1 is kind of important. There's a K1 in the chapter for you to take a look at. So just talk about formation of the partnership. Cash or property is contributed to the partnership, and then in exchange, the partner receives ownership interest. So, no different than starting a corporation. You contribute property or cash to the corporation, you receive back shares of stock. It's basically your interest in the corporation. And again, just like when you start a corporation, there is no gain or loss. You're just pooling your assets with somebody else. You're transferring ownership from yourself to this new business. So typically, no gain or loss is recognized upon contribution. It is deferred until taxable disposition of the property by the partnership or the partnership interest by the partner. So the partner's basis in partnership interest is the basis of contributed property. So the holding period rules may come into play. Holding period of partnership interest includes holding period of assets contributed. For other assets, including cash, holding period begins on date partnership interest is acquired. If multiple assets are contributed, the partnership interest is apportioned and separate holding period applies to each portion. Exceptions to the tax-free formation. So, it's not 100%. There always has to be some rules about that. What people basically just know, the exceptions are there because people try to do this and basically avoid taxes. The gain will be transfers of appreciated stock to investment partnership. Gain recognized by contributing partner prevents multiple investors from diversifying their portfolios tax-free. If the transaction is essentially a taxable exchange of properties, a gain would be recognized. So just know these are rules, and a disguised sale. These are rules to prevent people from avoiding taxes. Partner contributes property to a partnership. Shortly thereafter, he receives a distribution from the partnership. Distribution may be viewed as a purchase of the property by the partnership. Receipt of fully vested interest in partnership capital in exchange for services is generally taxable to the partner. And that's kind of one thing to think through too, as we have of our big picture with the Beach Cider Bakery, we have one person who is contributing his knowledge and know-how. He's basically his labor in exchange for a partnership interest. Then tax issues related to contributions of property. The partnership essentially steps into the shoes of the contributing partner. Continues the same cost recovery and amortization calculation, so the same depreciation methods and so on. Gain or loss is ordinary when partnership disposes of contributed unrealized receivables, contributed property that was inventory in contributor's hands if disposed within 5 years. So it's possible that one person is contributing inventory or receivables. It's a little bit different category. We'll do a homework problem where we'll talk about that. If contributed property is disposed of at a loss, and the property has built-in capital loss in the contribution date, the loss is treated as a capital loss if disposed within 5 years. Capital loss is limited to the amount of built-in loss on date of contribution. So I'm going to skip that one too. We'll get to that one later, doing some homework. So let's get back to the big picture. So Kyle and Maria are the ones contributing capital. Kyle's contributing land, and Maria's contributing equipment and some cash. There's no tax consequences on formation of Beachside Properties LLC for the LLC Kyle and Maria. Kyle does not have a gain, and Maria does not recognize a gain. Their contributing property just moves over to the new business. Kyle now takes a basis of $600,000 for his interest. Because the fair market value was 600. I'm sorry, his basis, was 600, his fair market value was 2. And then the basis of the equipment for Maria was 0. Maria takes a substituted basis of 1.5 million, which is the cash that she put in. And then Beachside has the following adjusted basis of the contributed property. A carryover basis of 600,000 for the real estate, and then the carrier basis of basically 0 for the bakery equipment. If the buildings and other land improvements had any remaining depreciable basis, LLC would step into the member's shoes to calculate depreciation, but there is none left to depreciate. Any future income related to the pre-contribution gains will be allocated to the contributing members. When Josh vests his 5% capital interest in the LLC in exchange for his services, the $200,000 is taxable to him. So keep that in mind. When you contribute your services to the LLC, that's taxable. It's like wages, essentially. Okay. Josh's 20% interest in future profits will be taxed to him as profits earned by the LLC. Elections made by a partnership. So again, when you start, some choices you get to make as you begin to file with the IRS. These are on page 12. There's a good little list on the top of page 12, a little shaded box there also. Which inventory method to use? If you want to be cash accrual or hybrid, your depreciation method is your tax year. If you want to amortize organizational costs and startup costs also. Let's see. So organizational costs, kind of the same thing we talked about previously with corporations. You can deduct up to 5,000 org costs in a whatever year you begin. Deductible amount must be reduced by organizational costs above 50,000, which then can be amortized over 180 months. So that's really the same thing as the C Corp. And then org costs include incident to creation of the partnership, chargeable to a capital account, and of a character that if incident to the creation of the partnership with an ascertainable life would be amortized over that life. It's like a bunch of legal stuff. Costs incurred for the following items are not organizational costs. So acquiring and transferring assets, admitting and removing partners, negotiating operating contracts, and syndication costs. So think more legal and accounting type things would be what we would call organizational costs. Startup costs include operating costs incurred after it's formed but before it begins. So marketing surveys, pre-operating advertising, cost of establishing an accounting system, training, salaries paid to executives, employees before the start. So we formed the business, but we haven't opened yet. So a lot of those costs that we just have to invest in without revenues coming in yet. Again, you can deduct 5,000 of those in the year you begin. Deductible amount must be reduced by startup costs in excess of 50,000. Costs that are not deductible in this provision are amortized over 180 months. And the method of accounting, again, cash, accrual, or a hybrid can be chosen. The cash method cannot be adopted, though, if one or more C Corps is a partner, or if it's a tax shelter. So that limits you. A C Corp has to use the accrual method. It cannot use the cash method. And then there's some limits, though, depending on your gross receipts. So you can make exceptions based on gross receipts. Your tax year, again, it depends, like everything else does, what that tax year would be. And they mention this on pages 14 and 15, so I'll just let you take a look at that. The least aggregate deferral with this one is, and this is on, let's see, I'm not saying it's, I guess, bonus content. So Crimson and Indigo are equal partners of CI Partnership. They use a calendar year. Indigo uses a fiscal year ending August 31. So one has a calendar year, one ends on August 31. Neither is a majority partner. They each are at 50%. Although they are both principal partners, they do not have the same tax year. Therefore, the general rules indicate that the partnership's required tax year must be determined by the least aggregate deferral rule. And the following computations support August 31 as their new tax year. And they'll walk us through how to do that. So just FYI. I don't think I have any homework based on that, but just want you to know. So I'm going to skip the tax year stuff. I'm going to focus more then on the measuring income of the partnership, which is a two-step process. And that two-step process is on page 16. Calculation of partnership income. Step 1, net ordinary income and expenses related to the trade or business of the partnership. And then step 2, segregate and report the separately stated items and other information that partners will need on their tax returns. And separately stated items are items of income, expense, gain or loss that might affect any two partners' tax liabilities differently than it would be separately stated. Separately stated items fall under aggregate concept. Each partner owns a specific share of each item of partnership income, gain, loss, or deduction. It's determined at the partnership level. Some examples of those: short-term and long-term capital gains and losses, Section 1231 gains and losses, charitable contributions, interest income, and so on. So some of these at the ownership partnership level may be taxed differently. So we separately state those so the partners can do their own separate tax returns. Okay, so they give us then an example of the big picture. So this is also on page 17. I return to the facts of the big picture. In its second year of operation, Beachside Properties reports income and expense from operating the cafe, as well as rent income and expenses from leasing other buildings. So you can see that the cafe is doing its thing under the LLC. We're also renting and leasing out some of the buildings under the LLC. And you can see the revenues, cost of sales, W-2 salaries, cost recovery, utilities, taxes, licenses, guaranteed payments, charitable contributions, short-term capital gain, net income from rental of real estate, qualified dividends received, exempt interest from a bond, AMT, taxes, payment of medical expenses, and distribution of cash to Maria. Beachside then will determine its ordinary income or loss for the year along with its separately stated items. Guaranteed payments are reported as income by the members and are either deducted or capitalized by the LLC. In addition, Beachside reports additional information that partners might need to prepare their individual tax returns. The LLC is not allowed a deduction for payment of Kyle's medical expenses. The payment's probably handled as a distribution to Kyle, who may report it as a medical expense in Schedule A, determining his itemized deductions, if he has enough expenses or enough deductions to itemize. Also, it cannot deduct a distribution to Maria. Distributions are discussed in Chapter 11. The AMT adjustment's not separate component of the LLC's income, as reported by Beachside members, so that they can properly calculate any AMT liability. And then last year, which was the first year of operations, the LLP had a $250,000 net loss from operations. Cannot deduct that loss, just so you know. Okay, and then guaranteed payments paid by the partnership. So again, from the previous example, they talked about those guaranteed payments, and it says here, assume that Josh was elected as managing partner of Beachside, is the sole authority to enter into contracts for the LLC. He is the sole authority to contract the LLC. He works 1,000 hours per year. Maria works 1,000 hours per year in the cafe. After transferring his land to Beachside, Kyle's generally not been involved in the LLC's operations. In addition, recall the LLC uses the capital contributed by Maria and Kyle of $2 million each. And then Josh and Maria both received guaranteed payments of $5,000 per month for services. In addition, Maria and Kyle both received guaranteed payments of $5,000 for the LLC's use of their capital. The guaranteed payments are $240 for the year, 12 months times 5 times 4. Beachside may deduct those payments, so just kind of be aware of that. And then in your chapter, they show us the 1065 tax return, which you can see right here. They're using the big picture amounts from examples 17 and 18 to show us example 19, which is what's on the screen. And they show us the same thing on page 21. And again, this is kind of that weird area where clearly we're in 2018 right now. The tax law went into effect January 1 of 2018, but we're in that weird year where we're still we're not to 2019 to be able to finish 18 and do the return. So the return you see in your book says 2017 on it, and that's the software you download. It says 2017 on it. But that return, that 1065 informational return, then is on pages 21 and 22, and then 23. So it's about a 3-page return in the book. You kind of just see what's going on there and take a look at it. So you might find yourself going back and looking at that as you do an example of one for a future homework assignment. And so this is then the additional information, stuff that's reported separately, kind of just going back a few slides, and some of the information that was reported to us back here, all that data given to us. Now we're just basically saying what information needs to be separately reported because it may affect the 3 owners differently. That's what this is about. And then to give us example 21, we just continue with the same facts. Now we say that they now have income of $492,100, and it must report what they call the analysis of income or loss and Schedule M1 on Form 1065. So that's on in your chapter, page 23, reconciliation of income or loss per books with income or loss per your return. And corporations do the same thing also, depending on their size. So they report this. You can take a look at that and what it looks like in your chapter on page 23. And that's it right there also. And then you have to do the Schedule M2 analysis of the partner's capital accounts. So basically it's kind of continuing with that and saying, how did the partner capital accounts change? You can see the beginning balance plus capital contributions plus net income minus distributions equals the new ending balance. Okay, then we get into partnership allocations, and this is on page 25 of your chapter. Partnership agreements can provide that partners share capital profits and losses in different ratios. It's just really up to what they want to do. There's no right or wrong to it. It's just what they agree on doing. It can say it can provide that partnership agreement may provide that a partner has 25% capital ratio, but be allocated 30% of profits and 20% of losses. And really, there's no limit to what it could be. I mean, it's basically whatever partners that get together and discuss want to do. The economic effects test then requires three things, and this is what they talk about on page 25. An allocation must be reflected in the partner's capital account. When the partner's interest is liquidated, the partner must receive assets fair market value equaling the positive balance in the account. And a part of the negative capital account must restore that account upon liquidation. So basically, by contributing cash back to the partnership, you get out of the negative balance. So then example 23 then is kind of those special situations or special allocations. It's at the very bottom of page 25. So Maria arrives at the bakery at dark 30, 4 a.m. or early, 6 days a week to make cinnamon rolls and croissants and make sure they're ready to go by the time the cafe opens at 7. She probably should hire somebody would be my answer to that. So they agreed to give Maria the first $30,000 of revenue from the bakery to compensate her for her time. Book income may be different from the 180 taxable income. To simplify the illustration, assume they are the same amount. Maria is entitled to the first $30,000 on that page, so she gets $30,000, and the remaining $150 then is split based on whatever the profit sharing percentages are. And this is what's exactly on page 25. Her in the beginning capital, special allocation, and then we allocate the rest, the 150, based on just whatever their ratios are. So you can see here 60/60 is 120, plus another 30 is 150, plus another 30 is 180, which 180 is their income. Partnership allocations must have a substantial effect. If it does not meet the substantial test unless it has economic consequences in addition to tax consequences. So just keep that in mind. So going back to the next example, assume instead the $30,000 was awarded to Maria in year 2 simply to allow her to use her personal expiring net operating loss carryover. So you said 1 year so she could take advantage of that. Even though the LLC's allocations meet the economic test, they would not be permitted because there's no substantial non-tax economic reason for the allocation. So it's not based on her extra service, the hours she puts in, and so on. Also, they talk about pre-contribution gains or losses. Must be allocated to partners, taking into account the difference between the basis and fair market value of the property on date of contribution. So for non-depreciable property, this means any built-in gain or loss must be allocated to the contributing partner when disposed of by partnership in taxable transaction. Then for depreciable property, allocations related to built-in loss can be made only to the contributing partner. So an example of the pre-contribution loss. This is example 25, which is on page 26. When Beachside Properties was formed, we know that Kyle contributed land, value of $800,000, basis of $600,000, and buildings value of $1.2 million, basis of 0. So that's the 800 plus the 1.2 is $2 million. We know that Maria contributed the cash and furnishings with fair market value of 500 and basis of 0. For book accounting purposes, Beachside records the land or other properties at their fair market value. For tax purposes, the LLC takes the carryover basis. The LLC must keep track of the difference between the basis in each property and the value at the contribution date, because when they sell something, gain must be allocated to the contributing partner and extend to the previous unrecognized built-in gain. So if they sell something, then we have to allocate some of that back. So if they sell some of the land that Kyle contributed for $1.1 million, we have to compute a gain. Okay. So amount realized, the taxable amount, the adjusted basis, the gain realized, built-in gain to Kyle, and then the tax piece of that too. So Kyle would recognize 320 the first gain, and Maria would recognize 120, and Josh would recognize 20%. So based on their income sharing of 40, 40, and 20. So that's what, they basically recognize the 300,000 gain and so on. Okay, then we get to Schedule K1, and again, that kind of goes with the 1065, keeping in mind that this is the form that the partners receive once the 1065 is done, and then a copy goes to the partners and a copy goes to the IRS. So just kind of think of your W-2 at the end of the year. Your employer gives you your W-2 and files a copy with the IRS also. So continuing with the examples from Beachside, Maria receives that first 30,000 of income plus a 40% share of the rest, and she's allocated 40% of all separately stated items. And they show us, and that's the K1 they show us on page 28 of the chapter. It's Maria's K1. And that's what they mention, is they show us what the profit ratios are and so on with her. So she has 90,000 of ordinary income, some charitable contribution, short-term gain, passive rental income, and then qualified dividend income. Okay. And then she lists her 840 share of tax-exempt interest. She must report ordinary income of 120 and the guaranteed payment, and so on. Excuse me. So in her personal return, then, she combines the partnership amounts with similar items from sources other than Beachside. So if she has anything else going on besides Beachside, she would just combine that with the K1. And this is what would go into her return. And then it says, continue with the example from Beachside. In addition to their allocations of ordinary income and separate stated items, Kyle and Josh report ordinary income on their guaranteed payments of 60. Maria reports her 120 guaranteed payment. Okay, so then at the end, the new stuff is the QBI, the qualified business income. That's on page 29. So recall, this was new in the new tax law beginning in 18. You're allowed that 20% deduction. And this is kind of what made, in this chapter, what made going with the LLC favorable above and beyond being a C Corp for their business, because they get the 20% QBI to reduce their taxable income. This deduction is calculated at the partner or S Corp shareholder level. The entity must report on K1 any information owners need to complete the return. So in general, the QBI is the lesser of the QBI or modified taxable income before the QBI reduction reduced by any net capital. If taxable income before QBI is more than certain threshold amounts, the QBI deduction cannot exceed the greater of 50% of W-2 wages, or the sum of 25% of W-2 wages, or 2.5% of the unadjusted basis. And that kind of goes back to some of the stuff we looked at way back on night 1 of the class, week 1 of the class. QBI is ordinary income less ordinary deductions, and QBI is calculated separately for each business. Combined QBI is the sum of these separate QBI amounts. Does not include guaranteed payments received for services provided to the partnership. And then remember that there were some exclusions. These all came back from way first night of class. And so then the big picture with the QBI, example 27. So now Beachside is income from real estate from a restaurant, which are qualified trades or businesses. They're not excluded, they're included. Combining the reporting of these two businesses on Schedule K, Beachside reports ordinary income of 180 and net rental real estate income of 300. In addition, Kyle and Maria each receive guaranteed payments of 60 for each of their capital, not services. The partners can treat their distributed shares of these amounts as qualified business income. And so the LLC, we saw, paid wages of $500,000. Immediately upon formation, the LLP, they spent $1.5 million on improvements. This is their unadjusted basis. The property contribution by Kyle and Maria is either land or fully depreciated property. Land is ineligible. LLC will allocate these amounts to Kyle, Marie, and Josh in the 40-40-20 ratio that they agreed on. For new partnerships, the partner basis usually equals the adjusted base of the property contributed plus fair market value of any services performed. And we know that Josh performed some services. For existing partnerships, the basis depends on how interest was acquired. If it was purchased from another partner, the basis is the amount paid for the interest. If it was acquired by gift, basis is equals donor's basis. In certain cases, a portion of the gift paid on the transfer. And a partner's basis and partnership interest is adjusted to reflect partnership activity to prevent double taxation. So the initial basis then is adjusted a little bit, and so you can see here what those adjustments are. And they give us the same list, just so you just know it's on page 34. So you can take a look at that and just kind of know what those adjustments are. Instead of me just know slide 90, page 34 is where they're at. Then partner's basis and the partnership interest can never be negative. Remember that. Partnership liabilities included in the partner's adjusted basis is an increase in liabilities or a decrease in liabilities. Okay, those are also included. And two types of debt. Recourse debt, the partnership or at least one partner is personally liable, or non-recourse debt where no partner is personally liable. And then constructive, and then I'm going to skip the constructive liquidation stuff. I didn't mean to bump my key there. I'm going to skip that part. And I think I'm just going to skip the rest. I don't have much in the homework based on this, but just know that this what you see here, this specific example, the big picture, example 31, is on page 33 of your book. And then this slide deck is just very long. It's just a very long one, over 100 slides. So the rest, I just kind of want you guys to kind of just know that you can go through that on your own and take a look at it. But it's really long. Okay, I've covered the vast majority of what you'll be given homework about. As always, if you have questions, please let me know. I'm more than happy to help you out.